U.S. energy exports are booming while American drivers are still paying high fuel prices. For households, that can feel contradictory. If the United States is shipping more energy into global markets, many people expect domestic fuel to feel more affordable. But gasoline, diesel, crude oil, LNG, jet fuel, and other products move through a global system. When that system tightens, pressure can return to the pump. The effect reaches anyone paying for gasoline, diesel, delivery, groceries, or transportation. Higher gasoline prices hit drivers directly. Higher diesel prices move through freight and delivery. When fuel stays expensive, the pressure can spread through commuting costs, shipping costs, and the price of goods moved by truck. The central issue is not whether exports are good or bad. It is how a global energy shock becomes a domestic cost problem. The chain is clear. Middle East energy disruption reduces global supply. Global buyers look for alternative fuel and energy products. U.S. exports surge. Domestic fuel inventories become thinner. Gasoline and diesel prices remain high. Drivers, freight operators, and households feel the pressure. Exports are not the only reason fuel is expensive. The verified research shows that international crude oil prices remain a major driver. It also shows export demand, thin inventories, high refinery utilization, and global supply disruption moving together. The United States is helping supply the world with energy while U.S. households face high transportation fuel prices at home. Reuters reported on May 5, 2026, that U.S. exports of gasoline, diesel, crude oil, LNG, jet fuel, and ethane had all surged to record highs so far in 2026. The increase came as U.S. energy firms responded to disrupted Middle East shipments and urgent global orders. From January to April 2026, combined U.S. shipments of those 6 energy products rose 20% from the same months in 2025 to more than 153 million metric tons, according to crude data cited by Reuters. More U.S. energy is moving overseas. U.S. supplies are being pulled harder into global markets at a time when global supply is disrupted. Domestic consumers face fuel prices shaped not only by local demand, but by global buyers competing for the same barrels, cargoes, and refined products. Reuters reported that the roughly 25 million metric ton increase in U.S. exports of those 6 products helped offset part of an approximately 82 million metric ton drop in exports of the same products from the Middle East after the conflict began on February 28, 2026. That explains the sharp export increase. The global market lost part of a major supply stream. Buyers needed replacement supply. U.S. exporters filled part of that gap. For global markets, those exports can help. Reuters said record U.S. energy product deliveries had likely helped limit fuel price increases around the world, even though prices remained higher in some regions. The same exports can create pressure at home. Reuters also said those exports have also created some supply tightness at home, especially in transportation fuel markets. That sentence is the warning for American households. Transportation fuel markets are where regular people feel the energy system most directly. Gasoline appears at the pump. Diesel appears in trucking, freight, delivery, agriculture, and construction. When those fuels are tight, the pressure does not remain inside the energy industry. It moves into daily costs. The export surge was broad. During the first 4 months of 2026, Reuters reported that U.S. gasoline exports rose 27% from the same months in 2025. Diesel exports rose 23%. LNG exports rose 26%. Ethane exports rose 30%. Jet fuel exports rose 82%. The export boom was not limited to crude oil. It involved the same products that affect transportation, freight, aviation, petrochemical supply chains, and global energy buyers. The fuel most visible to households is gasoline. According to EIA's gasoline and diesel fuel update, U.S. regular gasoline was $4.50 per gallon on May 11, 2026. That was $1.38 higher than a year earlier. For a driver, that changes the cost of commuting, school drop-offs, errands, small business travel, and family transportation. When gasoline rises, households have less room for other spending. Diesel was even more expensive. EIA listed U.S. on-highway diesel at $5.63.9 per gallon on May 11, 2026, up $2.16.3 from a year earlier. Diesel affects households indirectly as well as directly. It powers freight, delivery, and parts of the supply chain behind many goods. When diesel stays high, transportation costs can remain under pressure, even for people who never buy diesel themselves. California prices showed the regional burden more sharply. EIA listed California regular gasoline at $5.96.9 per gallon and California diesel at $7.32.1 per gallon. On May 11th, fuel was expensive, and the domestic cushion was thin. The inventory data confirms that point. EIA's weekly petroleum status report for the week ending May 8, 2026, showed U.S. crude oil inventories down 4.3 million barrels to 452.9 million barrels. Crude inventories were about 0.3% below the 5-year average for that time of year. Gasoline inventories fell 4.1 million barrels and were 5% below the 5-year average. Distillate inventories rose 0.2 million barrels but remained 9% below the 5-year average. Inventories are the buffer between supply shocks and consumers. When inventories are comfortable, the market has more room to absorb disruptions. When inventories are thin, price pressure can move faster. A smaller cushion does not guarantee higher prices by itself, but it reduces protection for drivers and households when global demand, exports, and crude prices are already elevated. Inventory drawdowns make the domestic fuel cushion thinner. Drivers and households face less protection from price pressure at the pump and in freight-linked costs. E&E News reported on May 7, 2026, citing EIA data, that U.S. fuel exports reached an all-time high in the week ending May 1, 2026. Even as crude oil, gasoline, and diesel inventories fell. It said U.S. petroleum product exports reached 8.2 million barrels during that week, up more than 1.5 million barrels from the same week a year earlier. Exports hit an all-time high while inventories fell. For households, the significance is not that every exported barrel becomes an immediate price increase. The significance is that export demand can reduce the domestic cushion when inventories are already falling. The same pattern continued into the next weekly data. Reuters reported on May 13, 2026, that crude exports rose 742,000 barrels per day to 5.49 million barrels per day during the week ending May 8. Gasoline exports increased to 1.05 million barrels per day. Refinery utilization rose to 91.7%. That last number is important. Refineries were running hard. EIA reported U.S. crude refinery inputs at 16.4 million barrels per day for the week ending May 8. Gasoline production averaged 9.8 million barrels per day, and distillate fuel production averaged 4.8 million barrels per day. High prices were not simply the result of refineries sitting idle during that week. Refineries were operating at high utilization, yet crude and gasoline inventories still fell. Gasoline inventories were below the 5-year average. Distillate inventories remained even further below the 5-year average. Exports were high. Prices stayed elevated. Refineries run hard. Export demand remains strong. Domestic inventories still draw down. The supply cushion shrinks. Consumers face fuel prices, shaped by domestic and global pressure, at the same time. That is why the exports story matters. The United States was not failing to produce or refine fuel in that weekly snapshot. The fuel system was being pulled in multiple directions at once. Domestic drivers need gasoline. Truckers and freight operators need diesel. Global buyers need replacement energy supplies. Refineries are trying to meet demand. Inventories are the buffer. When the buffer shrinks, households become more exposed. Crude oil prices are the other major part of the story. Reuters said U.S. fuel prices climbed mainly because international crude oil prices rose. EIA's May 2026 short-term energy outlook said Brent crude oil reached $138 per barrel on April 7, 2026, averaged $117 per barrel in April, and was expected to remain around $106 per barrel in May and June. EIA said global oil inventories were expected to fall sharply in the second quarter. The expected draw was 8.5 million barrels per day in the second quarter of 2026, and 2.6 million barrels per day for the full year. That explains why fuel prices were high even before looking at exports alone. Gasoline and diesel are tied to crude oil. When international crude rises sharply, the cost base for refined fuels rises. That pressure reaches drivers through pump prices and households through diesel-linked freight and delivery costs. A sharp rise in Brent crude creates a higher cost base for gasoline and diesel. The human impact is higher transportation cost pressure for households and businesses. The accurate story is not that exports alone caused high fuel prices. The accurate story is that exports, crude prices, global disruption, and tight inventories were all part of the same market pressure. Reuters said average U.S. gasoline costs moved from around $2.91 per gallon in February to $4.10 per gallon in April. Diesel rose from around $3.72 per gallon in February to around $5.50 per gallon in April. EIA's May 11 data showed gasoline at $4.50 per gallon and diesel at $5.63.9. That timeline shows how quickly the cost pressure reached consumers. In February, gasoline and diesel were much lower. After the disruption period began on February 28, U.S. exports surged, Brent crude rose sharply, inventories tightened, and fuel prices moved higher by April and May. The household impact is straightforward. A driver paying more per gallon has less money left for other expenses. A small business relying on vehicles sees operating costs rise. A logistics company paying more for diesel faces more pressure. Goods moved by truck can carry higher transportation costs. Families already paying for groceries, electricity, rent, mortgages, and insurance face another recurring cost increase. This is how energy exports become a household costs story. The export terminal is far from the grocery receipt. The tanker ship is far from the family car. The global crude market is far from the commute to work. The same energy system connects them. When global buyers compete for U.S. energy products and inventories are thin, the domestic market loses some of its cushion. When crude prices rise, fuel costs rise. When diesel rises, freight becomes more expensive. When gasoline rises, drivers pay more directly. The effect spreads outward from energy markets into household budgets. There are contrasting viewpoints. One view is that U.S. exports help stabilize global markets. Reuters reported that record U.S. energy product deliveries had likely helped limit fuel price increases around the world. In a disrupted global market, U.S. supply can reduce pressure elsewhere. That is the benefit side of the story. Us exporters and global buyers gain access to needed supply. The global fuel system receives partial relief. The United States becomes a major replacement supplier when another region's flows are disrupted. The household side is different. A second view is that exports can tighten domestic supply cushions. Reuters said U.S. exports had created some supply tightness at home, especially in transportation fuel markets. E&E News reported that crude oil, gasoline, and diesel inventories fell even as exports reached an all-time high. That is the domestic cost side. The same export boom can help global markets while reducing the margin of safety at home. This does not require assigning blame. It is a market trade-off. Energy products move to where buyers need them and where prices justify shipment. When global demand is urgent, U.S. barrels and cargoes can flow out quickly. If domestic inventories are thin, consumers at home can feel the pressure. Demand also requires caution. EIA reported motor gasoline product supplied averaged 8.9 million barrels per day over 4 weeks, down 0.8% from the same period a year earlier. That means the weekly data did not show a gasoline demand surge. High prices should not be explained as simply the result of Americans suddenly using much more gasoline. The verified data points to global crude prices, export demand, and tight inventories as major parts of the pressure. Refinery activity also requires caution. EIA reported refinery utilization at 91.7% for the week ending May 8. High prices in this context should not be reduced to a simple claim that refineries were not running enough. They were running hard, and inventories still drew down. The system was not under pressure because of one simple cause. Several forces were moving together. Global disruption reduced Middle East energy flows. U.S. exports increased sharply. International crude prices rose. U.S. gasoline and diesel prices climbed. Domestic crude and gasoline inventories fell. Gasoline inventories were 5% below the 5-year average. Distillate inventories were 9% below the 5-year average. Refineries were running at high utilization. Drivers still paid more at the pump. That accumulation is the story. For households, the final outcome is not measured in metric tons, export categories, or refinery utilization. It is measured in dollars per gallon, delivery costs, and pressure on monthly budgets. The timeline shows how the pressure built. In February 2026, Reuters said average U.S. gasoline costs were around $2.91 per gallon, while diesel was around $3.72. On February 28, Reuters identified the start of the conflict-related disruption period that reduced Middle East exports of key energy products and helped drive more demand toward US exporters. From January through April 2026, U.S. exports of gasoline, diesel, crude oil, LNG, jet fuel, and ethane rose 20% from the same months in 2025, reaching more than 153 million metric tons. On April 7th, Brent crude reached $138 per barrel, according to EIA. For April, EIA said Brent crude averaged $117 per barrel. Reuters reported average U.S. gasoline prices around $4.10 per gallon and diesel around $5.50 per gallon. For the week ending May 1st, E&E News reported U.S. petroleum product exports reached 8.2 million barrels, up more than 1.5 million barrels from the same week a year earlier. On May 5th, Reuters reported record U.S. exports of several key energy products so far in 2026 and connected those flows to global disruption and domestic fuel price pressure. For the week ending May 8th, EIA reported crude inventory is down 4.3 million barrels. Gasoline inventory is down 4.1 million barrels, and refinery utilization at 91.7%. On May 11th, EIA listed U.S. regular gasoline at $4.50 per gallon and on-highway diesel at $5.63.9 per gallon. On May 13th, Reuters reported crude exports rose 742,000 barrels per day to 5.49 million barrels per day, while gasoline exports increased to 1.05 million barrels per day. This timeline shows a pattern of global disruption, rising exports, higher crude prices, falling inventories, and elevated pump prices. Booming exports do not automatically lower domestic fuel prices. In a global disruption, exports can help supply the world while tightening the domestic cushion. At the same time, international crude prices can raise the cost of gasoline and diesel everywhere, including inside the United States. Energy does not stop at the border. If global crude is expensive, U.S. fuel prices feel it. If global buyers need gasoline, diesel, LNG, jet fuel, crude oil, and ethane, U.S. exporters can respond. If inventories fall while exports rise, the domestic market has less slack. If diesel stays high, freight costs remain under pressure. If gasoline stays high, drivers pay more directly. For ordinary people, the issue is not the export statistics themselves. The issue is the cost that remains after the export boom reaches the pump, the freight bill, and the household budget. As of May 18, 2026, the current reality is that U.S. energy exports are helping fill global supply gaps while domestic transportation fuel prices remain high. EIA's latest retail price data in this research showed U.S. regular gasoline at $4.50 per gallon and U.S. on-highway diesel at $5.63.9 per gallon. On May 11th, California prices were far higher, at $5.96.9 for gasoline and $7.32.1 for diesel. The latest weekly petroleum data in this research showed crude oil inventories down 4.3 million barrels, and gasoline inventories, down 4.1 million barrels for the week ending May 8th. Gasoline inventories were 5% below the 5-year average. Distillate inventories were 9% below the 5-year average. Reuters reported crude exports at 5.49 million barrels per day and gasoline exports at 1.05 million barrels per day for the week ending May 8th. EIA expected Brent crude around $106 per barrel in May and June, because global oil inventories were projected to draw sharply in the second quarter. Those facts describe a fuel market with unresolved pressure. Exports are strong, global crude prices are elevated, inventories are thin, gasoline and diesel remain expensive. Drivers continue to feel the direct cost at the pump. Households continue to feel diesel indirectly through freight, delivery, and goods. Exports are one part of a wider fuel price story. International crude prices remain the main driver. Export demand can reduce the domestic supply cushion when inventories are already tight. Refineries can run hard and still not rebuild inventories if demand from domestic and global markets remains strong. The same U.S. energy system can help global buyers support exporters and still leave American households facing high fuel costs. The export boom is real. The domestic price pressure is real. For regular people, the final result is not seen at an export terminal. It is seen at the gas pump, in diesel-linked delivery costs, and in the household budget.